This video will cover the topic of the financial statement assertions. These assertions relate directly to the substantive audit procedures that the auditor carries out during the audit process. In simple terms, the financial statement assertions represent the key objectives of the substantive audit procedures that are prepared. If a substantive procedure does not address an assertion, it does not assist the auditor in forming the opinion. The overall objective of the external auditor is to decide whether the financial statements are true and fair and properly prepared. True and fair can be described as free from bias, free from material misstatement, and factually correct. The auditor should also ensure the accounts have been prepared using an appropriate reporting framework. We look at this when we look at the auditor reviewing the financial statements as a whole. However, when the auditor reviews the financial statements in detail, it is more difficult to relate the term true and fair to the individual balances and transactions that make up the whole set of accounts. How can they see whether a balance is true and fair? Therefore, to assist the auditor in planning audit procedures that review whether the balance is free from material misstatement, they are given the financial statement assertions. These are outlined in ACCA 315. To help remember the assertions, I use CRAVE POC. The C is for completeness, the R is for rights and obligations, the A is for accuracy, the V is for valuation and allocation, and the E is for existence. Then the P is for presentation, the O is for occurrence, the C is for classification, and the final C is for cut-off. The assertion completeness is to ensure that all transactions and events recorded are present in the financial statements. Audit tests would be designed to identify if anything has been missed. An example would be reviewing the bank balances, including overdrafts. There is always a greater risk of items being missed in liabilities, and so the auditor requests a bank report to be sent directly to them from the bank confirming all balances. This will include any loans and overdrafts held at the year end. This will help confirm the completeness of bank and loan balances in the financial statements. The assertion rights and obligations is to ensure that ownership and responsibility of assets and liabilities is reviewed. Audit tests would be designed to identify if assets are owned by the entity and liabilities owed. An example would be the auditor inspecting invoices of assets purchased in the year to ensure they are in the company name. Accuracy is to ensure that all transactions, balances, and other items have been accurately recorded. Audit tests are designed to identify individual misstatements. An example would be to select a sample of sales invoices and recalculate the balances. The valuation and allocation assertion is to ensure that items in the statement of financial position are in the correct place and at the correct values. Audit tests are designed to identify if the valuation is reasonable and if accounting standards have been used appropriately. An example would be performing analytical procedures on the depreciation charge for non-current assets, comparing the treatment to previous years and industry methods. Existence is to ensure that items in the statement of financial position actually exist. Audit tests are designed to assess whether assets are being used within the business. An example would be to physically inspect a sample of assets recorded in the asset register. Presentation is to ensure that transactions, events, and disclosures are clearly described, relevant, understandable, and required by the applicable financial reporting framework. There is a term used in the auditing standard ACCA 315 stating that transactions should be appropriately aggregated and disaggregated. This simply means that items should be added together and shown separately where appropriate. Audit tests are designed to assess whether the information in the financial statements is presented properly and of assistance to the users. An example test would be to compare the revenue figure in the statement of profit and loss to the revenue note to the accounts and general ledger to agree that the breakdown is presented clearly and accurately. Occurrence is to ensure transactions and events actually happened. Audit tests should be designed to identify if these events are real. An example would be to verify employees on the payroll report to ensure that they work for the entity. Classification is to ensure that transactions are in the proper accounts and items have been disclosed correctly. Audit tests should be designed to identify transactions posted to the wrong account. An example would be to review the asset and expense accounts for evidence that transactions may have been misclassified as an asset or expense. Finally, cut-off is to ensure transactions are recorded in the correct financial period. Audit tests are designed to identify if sales and purchase invoices have been recorded in the period where the goods were delivered or dispatched. An example would be to inspect the goods dispatch notes just before and after the year end and compare to the sales invoice recorded. If the delivery date is before the year end, the sale should be recorded this year. If the delivery is after the year end, it should be recorded in the following year. Each of these assertions should be used within the substantive testing phase. Each of the assertions within CRAVE, so completeness, rights and obligations, accuracy, valuation and allocation, and existence, are used to test balances within the statement of financial position. These would be all assets, liabilities, and equity. Each of the assertions within POC, so presentation, occurrence, classification, and cut-off, are used to test balances within the statement of profit and loss, or income statement. These would be all income and expenses for the entity. There are a few assertions we have covered that are important for the whole of the financial statements, and can therefore be used for all balances and transactions. These are completeness, as the auditor would need to review whether all transactions are present; accuracy, as all transactions tested should be flagged if not accurate; classification, as recording improper accounts crosses both statements; and presentation, as the whole set of financial statements needs to be clear and understandable. I hope you found this video useful. Thank you for watching.